Welcome to the Monocle Banking Podcast, curated by Monocle Solutions. And this week, we continue pulling back the veil that has been cast over the world in our efforts to combat climate change and commitments globally to reducing our carbon emissions to net zero by 2050. Now, there's a growing chorus of voices of centrist reason from Wall Street to Whitehall who say calls for net zero emissions by 2050 are financially impractical and politically impossible and possibly naive. And it's a seductive argument. It's obviously true that the bulk of emissions come from fossil fuels globally, the oil, gas and coal industry that still make up around 80% of the global energy mix. It's also true that these fuels support tens of thousands of jobs and account for as much as 60% of export revenues in dozens of countries. So decarbonizing the global economy at speed is really quite hard to imagine, let alone accomplish. And it really is a big part of the global discussion that we're having, and it impacts all kinds of investment and business decisions. So my guest this week is someone who looks at the world through a more macroeconomic lens, and it's a great pleasure to welcome one of South Africa's foremost economists, Annabel Bishop, Chief Economist at Investec Bank. Annabel is the holder of the SACA Built Economist of the Year Award for 2010. She's won numerous monthly Reuters Econometer Awards and various focus economics categories for correctly forecasting a range of economic variables, which is always important when it comes to economics. And she's also authored a wide range of in-house and external articles and lectured widely at Gibbs, at the University of Pretoria, Wits and UJ. And I've certainly been very fortunate to share a stage or two in my career at various conferences with Annabel. So Annabel, really good to host you on the podcast. How have you been?
Thanks very much, Michael. Thank you for having me today.
Now, when we look at your career, I want to start firstly with a bit of a reflection, because you joined Investec back in 2001, which must feel like a lifetime ago. You've been an economist now, chief economist with the Zebra for 23 years. I think it must make you the longest serving economist in the group outside of Brian Cantor. Where did the love of economics come from?
Thanks, Michael. I think I discovered it at university. I don't think, when I was at school, there was sufficient focus or really interest in economics in the syllabus. That's certainly that I experienced. And I found economics very all-encompassing, but also, of course, very fascinating at university and very applicable to many areas. One of my first loves is still the financial markets, money and banking, and really understanding how relationships work with one another. If something is affected, what knock-on effects or ramifications does it really have? Of course, as the world changes and evolves, and I finished university in the late 90s, there of course are different factors or different topics that really come up, and that also then lends itself to scenario analysis. And of course, Michael, as you know, economists often are relied on quite significantly to make forecasts.
Absolutely. I'm always reminded of Jason Zweig of the Devil's Financial Dictionary, who rather tongue-in-cheek says of forecasting, it's a job that utilizes the irrelevant to predict the unknowable, something that is used by most people on Wall Street. It's tongue-in-cheek, but it just goes to show how difficult it is ultimately to make accurate forecasts. But that's really what economists are employed to do, to almost ascribe probabilities to things. When it comes to your day-to-day, many people, I think, have misconceptions of what an economist's role is inside a bank. What is your day-to-day? How do you describe what you do on a daily basis?
So we do look at all the incoming information and data, what's happening in the economy, what's happening in financial markets. For example, is the rand getting stronger or weaker? Why is the rand getting stronger or weaker? When we make our rand forecasts, we actually don't rely on irrelevant information. We rely on the history of the rand. And of course, the rand data itself. So what the rand has been for the last several months, several years. And of course, as well, what different factors affect it. So we know that that's just one part of many different areas. For example, at the moment, this year, the elections are quite important as well. And, we're looking at scenarios in terms of what could happen after elections, what different coalitions could mean. But ultimately, it all comes back to what do the impact of all of this have on economics. And of course, similarly for climate change as well. But also, of course, if we look at other areas in the economy, we look at geopolitical tensions, we look at crises overseas. Do the changes that we see in the trade, for example, because of geofragmentation in global trade, does that have an impact as well on South Africa? And there's many different factors, many different moving parts. And perhaps that really describes describes what economists do. They look at multiple moving parts and they try and bring it into an overall picture, what's most likely to result as a consequence, and of course as well, what are the risks to that central view? What could happen if things come out better or worse than expected?
And then as a bank economist, I'm sure that ability to gather all of that data together and make fairly reasonably accurate predictions on where we are in a cycle with regards to inflation and interest rates will then inform the credit committee's approach to lending in a particular cycle. Is that pretty much right?
I think that's all taken into account. And of course, as well, let's not forget Reserve Bank regulation. The Prudential Authority has certain requirements of banks. They have to report on the expected credit losses. We have to report on capital requirements as well. And a lot of that starts with our forecasts, where we both, as I said, create the expected case and different scenarios around it, and forecast multiple variables, whether it's GDP, of course, inflation, interest rates, you mentioned, many others, consumer spending, and of course, looking at the JSE, looking at all areas and really trying to give a sense that if we go through a bad period, what impact will that have on the bank's book? Will the bank be sufficiently provisioned to get through it? And of course, Michael, as you know now with climate change coming into the regulators' view as well, that's something they also focus on. But of course, as we move through these different cycles, as you said, or different stages, new requirements come up. And of course, that also adds to what we look at.
You talk about climate change, and I'm reminded of a quote by Thomas Sowell, who says, "The first lesson of economics is scarcity. There's never enough of anything to fully satisfy all those who want it. And the first lesson of politics is generally to disregard the first lesson of economics." There does seem to be this inherent tension between where politicians are making commitments and what the economics say about what is practically achievable when we talk about net zero. So maybe just at a high level, you can take us through this global push towards net zero. What does that mean in practice?
Yes, of course. Look, net zero really refers to the balance between greenhouse gas emission and, of course, what's removed from the atmosphere. And net zero really aims to seek to reach a balance where, obviously, we are not emitting. So either you reduce your emissions, but usually it's a combination of both. But, of course, as well, it can also include carbon capture. What all this really means is that in an economy, when obviously one sees economic growth and economic activity, which is always touted as a good thing, and of course it is, because that tends to create more employment, of course, aid individuals and households. You also, of course, have what is often known as a negative externality, carbon dioxide, which is produced, then, of course, can and does move into the atmosphere and obviously has contributed to global warming. The concern certainly is that this negative externality means that people perhaps who benefited from these carbon emissions, whether it was the factories that produced the goods, for example, then don't necessarily only have the negative effects. Individuals have the negative effects as well. And we've seen, of course, the impact of climate change around the world in terms of flooding and severe droughts. So all of it brings us back to net zero. And of course, the net zero or the Paris Agreement surrounding that really came into being around 2015, 2016. And it seeks to actually get us to net zero emissions balance, where we obviously don't see further emissions of greenhouse gases around 2050. And in order to achieve that, the requirement is that we actually need to reduce emissions by close to 50% by 2030. Why are we doing this? It is to limit global warming. It's to reduce the increase in temperature since just before industrialization. So, of course, the Industrial Revolution. And limiting global warming to 1.5 degrees or less is seen to have a much reduced impact in terms of climate change than if perhaps we saw global warming increase by 2% or worse, even 3%. And already since the Industrial Revolution, we've seen the world see global warming increase by 1.1 degrees. So, no, we don't have much room to go further. And the big concerns, obviously, is that as we see global warming progress, as we see the world getting warmer, the impacts of climate change, the physical risks become worse and worse.
And those physical risks are manifesting. If we just have a look at insurance rates, we see in some parts of California, they say that certain categories of home are now uninsurable. And we're starting to see these things manifest in a much more tangible way. That said, though, in this push towards net zero, we've got to have a look at the main culprit, and that is the burning of fossil fuels. And if you go back, if you look at what we've achieved in 2000, fossil fuels were 87% of total electricity mix in the world. In 2002, the burning of fossil fuels was 82%. So even with this huge boom in renewables we've seen over the last 10 years in particular, we've hardly made a dent because a lot of that has also been offset by an increased demand for energy. So it seems like an almighty task to get to net zero. How realistic is net zero as a goal? What are the main challenges as you see them?
Exactly right to highlight this is a concern, and in fact the path to net zero has been really underlined as being incredibly narrow, incredibly difficult to achieve. In fact, the International Energy Agency, which is a large body globally which looks at the impact of energy and of course on climate change as well, says that the commitments to reduce carbon emissions by 2030 made both before and after the COP28, the United Nations Climate Conference, concludes the world is on a path to achieve only a third of the reductions in carbon emissions needed to limit global warming to 1.5 degrees. And also, of course, as well, at COP28, we didn't see an adoption of a phase out terminology for fossil fuels. We actually instead saw the adoption of a phase down. Now, of course, that talks to the point you make, Michael, and the difficulty of eradicating the use of fossil fuels, again, something that's not seen as very realistic. So the International Energy Agency does really recommend that we need to reduce fossil fuel emissions and triple clean energy investments. And of course, as well, the need for financing, for green finance, becomes even greater for emerging markets and developing economies. In fact, they actually estimate that current investment in clean energy is around 260 billion a year, but it should be closer to 2 trillion a year. So you can see there are just many parts to this topic.
And it's very difficult to bring all of those moving parts together. But that is what we're trying to do in a world where we see increasing protectionism, we see nearshoring, friendshoring, call it what you will, in manifesting in things like the Inflation Reduction Act in the US or carbon border adjustment mechanisms, which are increased taxes of carbon-intensive products into Europe. But often these things can work in tandem, but they can also work against each other, and that's what makes us so complex. I want to come back to the impacts of climate change, though, and the physical risks such as severe weather events or flooding or wildfires or that kind of things. What do you see as the key impacts of climate change on banks and those that banks lend to?
Michael, we're entering the debate, which many regulators are looking at as well. And of course, at what time period do you look at climate change? And, when I was talking earlier about bank regulations, when we look at credit losses and, of course, provisioning and many other areas that the regulators require banks to basically put safeguards in place to deal with unexpected events going forwards. That's usually done over a 5-year horizon. But of course, we've already talked about the 230, the 250, and of course, the goals and limiting global warming to 1.5 degrees by the end of the century. All of these factors talk to a much longer time period. They talk to 20, 30 years out. And of course, from that perspective, we really find ourselves in a situation where the impact of climate change, while apparent and significant around the world, and again, attributed to something which will likely increase in frequency and severity, has not yet had its full effect felt. And of course, what we mean by that is that, yes, we've had bad droughts, and as you know, that's dried up the Panama Canal. And then, of course, we also have had severe flooding. We know what's been happening in South America. We've had, detrimental negative effects, especially on human life, as well on economies and assets, whether it's property or other types of portfolio assets. But the effects of climate change are expected to exacerbate and get a lot worse as global warming warms up considerably. Of course, that's really where you talk to physical risk and the impact of physical risk on finances. And, it also has an impact on delivery times, for example, for transportation. And all of this really comes together in terms of the economic impact of climate change. Again, that obviously feeds through to society and individuals. But from a physical risk perspective, as I said, there's expectations that the sea levels will rise quite substantially if we don't see enough climate change mitigation. And these factors, of course, would worsen or exacerbate the situation that we're experiencing. So, from a banking perspective, the regulators are still really in early stages in terms of implementing regulations and requirements.
Well, on that point, I was going to ask you whether or not our financial regulator, primarily the SARB and the FSCA, have introduced requirements or supervisory expectations for financial firms to now collect and analyze this data on climate-related risks on their balance sheets.
Yes, so what we've seen is that the Prudential Authority, the South African Reserve Bank, already a couple of years ago, they gave us a stress test to do. And from an economic perspective, we were involved. The stress test was really, it was a fairly simple one, but it was saying, what impact on the economy do you experience if we go through significant drought? Now, as an economist, I've spent really the last 20 to 30 years looking at weather conditions in South Africa's impact on food, and particularly food prices. And the reason for that is that food price inflation makes up the largest component of South Africa's consumer price inflation basket. Now, CPI inflation, as we know, is extremely important both for interest rates and, of course, as well, the bond market, but also, of course, for the economy as well. When you're in a high inflation environment, of course, we've come through a relatively high inflation environment for the past couple of years for South Africa. That reduces real spending for consumers. It means that when inflation is higher, you can buy less in real terms. The number of items you end up with are less if your salary and wages don't increase. So returning to the climate change scenario request of the Reserve Bank, we did run different scenarios looking at different drought periods, and we can benchmark historically as well, because South Africa, of course, is a dry country, and we have been through terrible droughts which have pushed up food price inflation sometimes into double digits. So that's an example, of how we do our work. When we do our econometric modeling, we do look at historical periods. We can provide benchmarks. We can also look at better and worse periods to create scenarios around our expected case. But let us also, of course, remember that while we've had those bad droughts, we've had those negative effects, climate change certainly means that they'll become increasingly frequent and can worsen. But we've also seen in South Africa as well, but other countries around the world, we often tend to see that you get more rain for South Africa on the east coast and drier conditions on the west coast. So there's different factors that can be built in. That, of course, other data, which is quite difficult to collect as well and really get applicable for South Africa on a macroeconomic basis, is what effect does severe wind damage perhaps have? Very severe storms, very high levels of precipitation, as we said, rising sea levels, and wildfire risk. We've seen those terrible wildfires in Canada and California. All of those factors build, as you mentioned earlier, into insurance risk and, of course, into a number of areas.
Absolutely. And the insurance risk, it's quite interesting, Annabel, when we had those extreme floods in KZN a couple of years ago, a group of academics led by the University of KwaZulu-Natal and a pair of European universities have been studying the sediment in the seabed off the Durban coast. And they went back in geological time, in a blink of an eye, it was only 6,000 years, back to a period where we had a warm age. And the conclusion was that cyclonic type activity was much more frequent based on that study 6,000 years ago. So it would be relatively safe to assume that if we are seeing a warming ocean and warming temperatures generally, that we can see more extreme type weather events in Durban and KZN, which means more flooding, which impacts insurance, which impacts reinsurance and the built environment and how you build. And so, the cascading effects are enormous. And when I think about how we think about climate change, I think we spend a lot of time talking about mitigation. So how are we going to transition from fossil fuels to renewables, but not enough time on adaptation, because to your earlier point, the pathway is very narrow. It looks already like we might be missing that very narrow pathway of 1.5 degrees. So should we not be thinking more about how do we adapt to a more warming world and investing capital based on those decisions? But I want to come back to the regulatory and policy aspects of this. A lot of it hinges on the taxonomy and the green taxonomies. Are there particular green taxonomies or standards in South Africa that financial companies and insurers or investors use to classify green or sustainable investments or assets? And how is that green taxonomy evolving?
Well, interestingly, Michael, our National Treasury produced a document called South Africa's Green Finance Taxonomy. And of course, as you know, Green Finance Taxonomy is really just looking at a framework or a definition body for green finance, but really just to find out what projects qualify as being part of those which obviously would be financed under green finance. So it's a classification system, a cataloguing, if you will, of a minimum set of assets, projects, activities, and sectors. And of course, South Africa has worked on this document. In fact, the work started earlier than 2022, both with a number of global institutions and, of course, with bodies in South Africa as well. And they have provided a large definition document. As we know, a lot of investments into the ESG space are obviously mostly voluntary, but of course inside companies as well. Inside funds, they might have mandates. But overall in South Africa, I think that this is certainly an area which is growing, but it is a very supportive document. If you read through it, it does provide a lot of the basis for a green finance taxonomy for South Africa.
That is very interesting. When you look at it, in your view, how successful is the application of these standards so far? And I know it's very early on to assess, but in directing credit and investment flows to more sustainable projects.
Michael, again, I think, and of course, we've seen what's happened at COP28. We've seen, obviously, what's happening around the world with much warmer weather, with impacts on crops, and of course, warnings that we're getting from the scientists, the quicker melting of global ice caps, etc. We often find that, progress perhaps is not as rapid as we would like in this space in terms of green finance yielding results. It doesn't mean that it's not there and it's not available. Of course, you get different types of green finance as well. And of course, we know we wouldn't discount international aid, money coming from overseas, either in the form of grants or obviously very cheap loans. You also get, development banks, again, who work in that space, and your banking sector. All of that really works together to try and provide a more positive or perhaps uplifting incentive towards actually greening the economy. In fact, if we actually have a look at the work that's being done by the Network for Greening the Financial System, that's actually a global body which is really looking to manage the risks and mobilize capital for green and low carbon investments in the broader context of the environment, sustainable development. And of course, this is a global body that most central banks and banking institutions subscribe to. Again, it provides a lot of information and scenarios which can help banks plot both what transition risk and physical risk is going to mean for them. So overall, I would say that a lot of the work is still in early stages, but you are seeing progress being made, perhaps more in advanced economies than you're seeing in emerging markets and developing economies.
What is the appropriate role here of financial policy, of regulation in the transition to a low carbon economy?
Well, I think, the regulators themselves, so they're still in the early stages of trying to bring through the regulations and policy changes, particularly in the emerging market economies. But nevertheless, we've seen great progress made in some of the advanced economies, whether that's the Inflation Reduction Act in the United States, which really seeks to green the US economy and to do it fairly quickly and rapidly as well. And I think, just having a look at this inflation reduction, it seeks to build a new clean green economy powered by American innovators, American workers, etc. So really trying to boost employment in the United States, but also about social upliftment in other areas. So it is certainly more of a carrot than a stick approach, whereas we look at what's happening in Europe, and they've got a CBAM legislative document which is looking to increase taxes for importers on manufactured goods, which could come from around the world or perhaps even inside the EU itself, which have got a high carbon content in terms of their manufacture. And of course, that's more of a stick approach. I think, you do see these differing approaches that come through. And as well, in South Africa, we've made progress in terms of carbon taxes. But I would say that our climate change journey, while we've got a lot of documentation in place, and of course, we know the just energy transition as well, we haven't progressed, very far in terms of the regulations applications.
Yeah, and that's again why we're having this conversation now, to better understand which way the regulatory, travel might take us. Because in Europe, when you look at what the European regulators are discussing currently, they're having a look at capital charges for banks who fund fossil fuel projects. And it seems to be gaining support amongst EU politicians, while advocates of the proposal claim that it would reduce the probability of a financial crisis triggered by the climate crisis. One wonders how that might impact banks in emerging markets like Southern Africa, who are still funding oil and gas projects because there is deep energy poverty across the continent. And if you're now going to make it more costly for banks to do so, is there an unintended consequence here of subjecting Africa, for example, to further energy poverty in the name of greening the environment, of getting to net zero? These are the kinds of trade-offs that I often worry about. What are your thoughts on the way the regulators are approaching this in Europe from where we sit here in South Africa, and the unintended consequences that could happen?
Yes, I think that is an important point to consider because often the regulatory changes that we do see happening in Europe, as you said, feed through into Africa, South Africa, other areas of the world to the Basel requirements, but also, of course, other regulatory requirements as well. Look, at the moment, banks are required to hold around a minimum of 8% capital against their assets. And, they're talking now of well over 100% of risk-weighted capital requirements. So basically holding capital for more than the entire project, which is obviously just meant to be a disincentive. It's obviously meant to dissuade providing investment, providing loans, providing finance for projects which are not seen to provide a greening effect on the economy, which are not either change mitigation or climate change adaptation projects, and instead obviously to promote the move away from fossil fuels. And I think, there is awareness of the negative effects that can be had, for example, on coal workers, on oil workers. In South Africa's just energy finance transition, there's specific focus on the coal industry, on its workers, which would be at risk of losing their jobs and financial hardship under a very rapid transition. Perhaps, Michael, one of the reasons why we're seeing around the world these slower transitions, the net zero goal is obviously seen as a very, very rapid transition, one which, of course, as we said earlier, is seen as a low chance of being achieved now. But, of course, if we look at the impact that the just energy transition would have on South Africa, there's obviously finance and other efforts involved there to try and soften the impact that would be had. And I think probably that's a path that would need to be taken. We talked earlier about politicians and, of course, the impact on economies. And often you have an early adaptation disadvantage. That really means that if you go quite hard and strong into climate change mitigation, climate change adaptation, you can obviously have a negative effect either on a corporation's finances, on a country's outcome, on employment. And, of course, that's sometimes the disincentive for politicians as well.
Yeah.
Politically, their popularity would fall and a different politician could get voted in who was less green, who was more supportive of the entrenched fossil fuel economies, and that then in itself delays the transition.
Again, it shows you how complex the situation is when it comes to analysing all of these moving parts, which we're going to be doing at the Beyond Banking Conference at Gibbs to some extent next week. Annabel Bishop, really looking forward to that, and thank you for sharing your insights and your frankness here on the Monocle Banking Podcast with me this week. See you next week.
Thank you, Michael.
Well, before we go, I'd like to extend our gratitude to our growing audience for tuning in. Please remember to like and share the content and subscribe for more from the Monocle Banking Podcast. Thanks for tuning in. That was Annabel Bishop, Chief Economist at Investec Bank.